Welcome to New Home Insights, the podcast from John Burns Research Consulting. I'm your host, Dean Worley. If you want to follow market trends, demographics, capital, new ideas, and endeavors that touch on housing, we're going to try to make sense of that every couple of weeks. Let's go. Hi, everyone. This is Dean Worley for the New Home Insights podcast. It's spring again. The flowers are blooming, presumably, in some places. Everyone is rushing out to sales offices right now to buy a new home. I mean, maybe not everyone. That's true. We hope as many people as possible. Hopefully, some of us are doing that because historically, as you know, spring selling is the top of the market, is the peak of the market in terms of activity. So, as most of our listeners know, that we're into tracking the housing market on a daily basis. We look at every permutation you can think of in terms of what's going on in the market. Two of the folks who are critical to that effort are Kara Lavender. She's a senior research manager here, and Dylan Krieg, he's a senior research analyst, and they handle our survey. They're keeping tabs on the market on literally a daily basis. Everything that's moving and trending, they're on top of. So Kara, Dylan, how are things going? How are you doing this morning?
Hey, Dean, doing good. Happy to be here talking about the spring season.
Yeah, doing all right, Dean. Enjoying the beautiful California spring we have here.
Well, I actually want to start with that. So Kara, you grew up in Georgia, which actually has 4 seasons.
We do, maybe 6 seasons if you count fake spring, fake winter.
Dylan and I and Richard as well grew up in Southern California, where we do not have 4 seasons. We have 2 seasons. We have mild and damp, and then we have crazy hot and very, very dry. But, I remember actually, Dylan, did you hear this too? When they say those phrase, April showers bring May flowers.
Yes, I remember that.
Were you as baffled as I was by that? Because we don't have showers in April.
Yeah, I haven't seen a single shower here in
Never.
April. We had one for like 2 seconds last weekend. I don't think that really counts though.
This year is the worst time for me to say that. But back, there was never April shower. So we didn't understand the idea of spring. So I wanted to actually use that to start off with kind of a fundamental question is, how critical is the spring selling season compared to past years? I mean, we have a lot of activity in warm weather climates where, you can get out earlier to go start shopping for homes. And you also have the online sales have become such a critical part of the new home sales process that, how important is that still? Kara, I'll let you kind of answer that. How much is spring selling still such an important part of the year?
Yeah, it's a fair question. And a lot has changed, right? Compared to even 3 years ago, but you look back 5, 6, 10 years ago, kind of the online landscape that's been shaped now for buyers, whether you're looking on the new home or the resale side, a lot's changed, right? So you can view any kind of home, all kinds of homes on the builder side. Buyers can select their lots, even view lot premiums, make their design selections. And you can even submit an offer and actually go to contract just by being online, never even walking in the sales office in a lot of cases. So it's without question, a lot has changed. And I think that lends itself to a much more educated consumer that may or may not walk through your model home doors, right? They have looked at every option they can find, whether that again is new or resale. So you have a very educated buyer who's done the comparisons. They know what's out there. They know what they want. But there's a lot of things, regardless of where you are, that haven't changed. I think that are still the fundamentals of why spring continues to be when we typically see the peak activity. And a lot of that has to do with schools, right? So despite being in Atlanta, despite you guys being out in San Diego, a lot of schools are starting in that August to maybe September timeframe. And so most families aren't going to want to purchase a home, uproot their kids in the middle of the year. So listing your house, putting an offer in the spring season gets you into that home before school starts, which I think is a big driving factor. There's also a lot of other things. So you think about tax refunds, right? They're coming out and around the first quarter, that's putting more cash into a buyer's pocket for maybe down payments, closing cost assistance. And we also see a lot of kind of life changes, job changes happen in the spring. So similar to tax refunds, a lot of employers are paying out their bonuses in that first quarter. So you get your bonus, maybe that puts, again, more cash in your pocket for down payment, for closing costs, or maybe that bonus wasn't what you wanted it to be and you end up changing jobs and moving to a different metro area and having to list your house and move to another area. So I think, yes, a lot has changed. And of course, there's been a lot of headwinds over the past 1 to 2 springs. But the fundamentals remain of why spring is a good time for people to make those moves.
And holidays too. I get it. At the end of the year, holidays, you clear that. But in weather-wise, purely from that sense, in California, it could be in January. So, and sometimes things do start earlier. But you look at the patterns, and even in California, you still see the buildup as January into February into March and April. You still see that buildup. So that's good. So I'm glad to say that because that means I haven't totally undercut the premise of this episode by poo-pooing the whole spring selling season, and it is still important. So I feel good about that. So let's start with you again, Kara. How has the spring selling season 2026 gone so far? And I'm hesitant to ask that question, but go ahead.
I'm hesitant to answer.
Right.
I mean, we're sitting in about May now. And really, we see the spring start in February is really when we start to see that uplift in demand, both on the resale and the new home side. And generally, spring 2026 has been falling pretty flat. I know that's not what we wanted to be saying on this podcast, but we've still seen a lot of headwinds present as we have moved through the spring 2026 season. We started to hear optimism going into January and even the beginning of February. There was a lot of optimism. We started seeing some pricing stability emerge, some momentum on sales rates coming out of the builders. But then you add on this now very volatile geopolitical landscape, and it's just added another headwind to all of the pre-existing headwinds we had going into this year. And it's really kind of similar to what happened in spring 2025. Again, we started to see some optimism and stability coming through in the early months of the year. And then you had this on again, off again tariff uncertainty that really ended up plaguing much of 2025. And so it's kind of a similar thing that we've started to see through 2026. And, we've seen sales rates continue to slow on a year-over-year basis. And really the reason they haven't completely fallen off a cliff is because of what builders have been able to do on the pricing landscape with their incentives, with all the pricing levers they've been able to pull. They've been able to keep sales rates up, albeit still continuing to slow.
Honestly, it's interesting you say that because it does seem like going back to COVID, the home building industry has been amazingly adaptable in times of stress. There's been different kind of stresses, but it has been different stresses. And let's dig in then to some of the key specifics. Let's talk home prices. And of course, obviously, if you're going to talk about home prices, you're going to have to talk a lot about of incentives. So what kind of changes and trends have we seen here in the early part of the year in terms of pricing and incentivizing?
So on the pricing side, it's a little bit of a good news, bad news situation. So to start with the bad news, pricing is still weak, really. Builders' incentives are still very high. There's not a lot of pricing power, not a lot of builders who are really increasing their net prices this year. Still a number of builders who are lowering their kind of net pricing. That means either reducing base prices or increasing incentives or really increasing, option or other sort of spends. And that's not really what we want to see in the spring, because the spring is really where builders take the lion's share of their price increases or the reduced incentives throughout the year. In fall and winter, a lot of builders are really focused on meeting those yearly sales goals, getting excess inventory out the door, preparing for spring. So it's not really where they take pricing improvements. Really what we see is that comes in spring. However, obviously we're not seeing that this year. I did say there was some good news though, and really what it is that things are a bit more stable this year than they were last year. Last year when we hit spring, especially with where rates got to in spring of last year, they hit like 7% right in the middle of the spring season, which is not what we want to see for the market as well. Really, we just saw pricing power just go down through pretty much the summer of last year, which was very weak. This year though, it's more stable, as I said. There are fewer builders who are decreasing prices, still not very few people who are actually, seeing good momentum on increasing prices. But you can see this with like the incentive levels as well when you look at things. So back in November, I'd say we surveyed builders asking for their average, incentive as a percent of sales price that they're offering. Mm-hmm. And so this number is national. So keep in mind, it includes the Sun Belt, where you got double digit numbers still out there, Midwest and Northeast, maybe it's lower single digits. Their average is like 7.5%, which is a high number. That's still a pretty high incentive level. And again, there are some pretty large double digit numbers in there still. As of about February, though, and I think through probably a lot of the season here, it's down to more like 7%. So down a little bit, but, call it flat to slightly down. And really what we've seen is you can see this with like the public builders as well. When you look at their reporting, over the last couple of months. There are some mixed, results. Some builders are seeing some better momentum. Some are seeing some little bit worse momentum. But if you look at just like the big two out there, that's D.R. Horton and Lennar, who have been really at the forefront of the incentives out there. They're saying flat, very slightly down, maybe in the second quarters here. And so really overall, the pricing environment remains weak. Builders are using these lower prices and these incentives to generate those sales rates that Kara was talking about.
Have you noticed any clear geographic? I mean, I think you mentioned some Sunbelt. Is it what would you expect the Floridas, maybe the Carolinas, that are leading the way, if that's the right term, in terms of incentivizing?
Yeah, no, you're totally still seeing that in the Sun Belt. I'll say I think that's actually some of the areas where we've seen things flatten out a little bit because they, took such big hits last year. But by and large, incentives still very high across a lot of the Sun Belt. Texas still sees a lot of incentives. The Southeast, Southwest, California is a little bit mixed here and there. It depends on the individual market for sure.
We were seeing some pretty solid markets in like the Midwest, the Appalachians, if you will. Has that held firm here so far in 26?
Yeah, I think so. I think things are a little bit slower maybe than they were last year. And part of that isn't just that they are like slower in and of themselves, but they're relatively not as good as they were compared to all the other markets last year because all the other markets took such big hits last year. But yeah, in general, Chicago, Indianapolis, some of the Ohio markets in particular continue to be pretty strong. There's some of the builders' best divisions. Now, it's not to say that they're, running away with the game or anything. They're still having their own challenges, but they're definitely more stable as we would expect.
So should other cities that are doing a little worse right now, should they just put Appalachia at the end of their city name? Could Austinapolis be the answer? I don't know.
Exactly. Jacksonville-Appalachia. Who knows?
Jacksonville-Appalachia. I mean, I'm throwing it out there. If you guys want to go ahead, free advice again. How about the shape of these incentives, Dylan? Is it a lot of buy downs, or has that also kind of diversified lately?
I think in general, and what I would say is that while builders have definitely tried to experiment with different things, we saw ARMs adjustable rate mortgages became actually a bigger part of the story late last year. That has come down as rates on adjustable mortgages. Those were really lower than the market, like 30-year fixed rate last year. And, for a 7-year fixed loan, for a lot of buyers, that's, not too bad of a proposal is really what was out there mostly. But we've seen ARM rates go up really substantially over the last couple of months. So that's kind of killed that game. D.R. Horton, I think we're just talking about it recently, that their level of ARM usage is down sequentially from where it was last year, but it's still above zero, which is where it was for last couple of years. Overall, though, buy downs remain the name of the game. That is true on ARMs. That is true on 30-year fixed mortgages. I don't have an exact number for you, but I would want to say, almost all of these sales, at least from the production builders, have a buy down attached.
Do you think ARMs suffers also from a stigma? A perceptual stigma
100%,
from, if your parents went through the aughts, then they're saying don't do an ARM. Even if the ARM is a very different vehicle now and is much more of a rational lending vehicle now, it doesn't matter. The lesson learned stuff.
Yeah, 100%. Our New Home Trends Institute, they've actually done research on this, talking to consumers. And if you talk to, us kind of Gen Z folk, the youngest of the millennials who didn't really go through the crisis and who might be reaching kind of their prime home buying age, not opposed to it really. They don't have that stigma. But if you ask, the folks who were prime home buying age, who went through financial crisis with the ARMs and everything, it's definitely the level of people who are like, yeah, I'm not comfortable doing that.
And if they're asking their parents for advice, or even their parents are helping the down payment, the parents are saying, absolutely not. You will not be in an ARM.
Yeah, that's a great point.
Kara, let's use that as a segue for, let's talk about mortgage rates and how have mortgage rates trended so far this year, and what kind of impact has that had on the spring selling season so far?
Yeah, a lot of people are happy to see right towards the end of February, beginning of March, we actually started to see a 30-year fix with a 5 in front of it, which I think was very welcomed by buyers, consumers, builders, everyone.
I remember that day. It was a
day is about the right time frame. It was
I
very
literally
short-lived.
posted something on LinkedIn on that 599, and it was an hour later that they updated on the Mortgage Daily News, and it was 603 or something like that. It was so sad.
Yeah, so they quickly went back up in March. They hit around that 6.5 range. They've been trending down since then. I think we're sitting at a 6.3, 6.2 today. But really, that's reinforced that kind of consumer psyche of, I just saw a rate with the 5 in front of it. Maybe I need to wait a little bit longer. It's this volatile environment that makes the consumer feel so uncertain, and is right now the right time to buy. Dylan mentioned that we've seen prices falling in a lot of markets across the country. And so there's been this catch the falling knife mentality add on this back and forth volatile rate movement. And that psyche on the consumer just continues to be, I think I'm going to sit on the sidelines and wait.
Mm-hmm.
And, through our New Home Trends Institute, we've done a lot of consumer research, and 5.5 is always that magic mortgage rate that comes back that'll make people feel comfortable to get out back in the market, start making offers, list their homes. But when you think about it from the new home perspective, these big builders have been buying down to 5, if not below, for several years now. So when we're thinking about it, does rate movement really impact it that much? I don't think it's going to be the saving grace. There's other components of the equation, right? To get to this affordability issue, we need that wage growth, we need price relief, and we need the rate relief. So all of that combined is what we need to make the movement and adding to that consumer uncertainty.
But hasn't it, what has been happening lately with affordability this year?
It's been improving. We're not at 7% rates. And when you look back historically, a 6% rate really isn't bad when you look at it. And so we have seen improving affordability, albeit at a very slow pace. But we have those rates that are no longer at 7%. We've seen home prices, both on the new home and the resale side, come down from the prior year. And we've had decent income growth. And so we have seen national affordability. Of course, this varies substantially by markets, by region. But when you look at national affordability, we've seen it improve to roughly its best level since 2022. So it definitely is a green shoot. But I think overall that volatility in mortgage rate movements adds on to consumers saying, I'm going to hold off for right now.
So you don't think that mortgage rates are going to be the end all be all by themselves. But how about that 5.5 is not impacting the new home market so much because folks have been buying down below that for a long time now. But couldn't it really kind of propel the resale market, the existing home market, and then get a lot of folks off the sidelines that way?
Yeah, it definitely could. And I think that's a tailwind for the resale market. That lock-in effect that was very prevalent back in 2022, 2023, it's slowly been thawing. But at the end of the day, I think as of the fourth quarter of 2025, we still had about 80% of borrowers at a rate below 6%. So while the lock-in effect is thawing and a 5.5 will help that thaw further, it's still very much present.
Yeah. That reset from old mortgage, whatever your 3.2 to your 6.2 or 6.3, or even a 4.99 that you get via a new home buy down, that's still happening at a pretty glacial pace. It has to.
Yes. Yeah, absolutely. It's going to be a slow roll to get off of that.
I'm surprising Kara with this, but what do you see mortgage rates doing the rest of the year?
We are not forecasting a meaningful decline in mortgage rate. We forecast mortgage rates the same way a lot of other firms do, right? So you have the 10-year treasury and that typical spread. The spread previously, you look back to, 9, 12 months ago, and that spread was pretty elevated. And we had the announcement of the government buying back the MBSs, really getting up to their cap. So that squeezed a lot of the juice in terms of getting that compression. We're now back down to about a 2% spread between the 10-year treasury, 30-year fixed, which is historically really normal. So keeping that historic 2-year spread or 2% spread over the 10-year treasury, forecasting you look out to 2029, rates really hovering in that 6.3 to 6.5 range still.
I thought the spread was more normally about 150 basis points, and we are still a little above that long-term normal. Or do folks feel like the new normal is more like 200 basis points?
I think 200 basis points is really starting to feel like the new normal. We were up to 300 basis points plus at one point. So 200 basis points when we look going forward is really looking like the new normal.
Dylan, as you mentioned just a second ago, we track consumer sentiment here at John Burns Research and Consulting. How are potential home buyers feeling about the state of the market right now? I think we can guess a little bit, but in terms of the actual data, what are you seeing?
Well, Dean, they're not feeling very good about it to start. If you look at one of the main surveys about consumer sentiment and just measuring how consumers feel about things is the University of Michigan's Consumer Sentiment Survey. Their survey says that the level of consumer confidence and sentiment around buying a home is pretty much at 30-year lows right now. We're talking like 1980 levels almost. For a reminder, 1980 was when rates were 20%. So it's very, very, very difficult on the consumer sentiment side. Consumers just are having a very tough time because they've been hit by a lot of different things out there. And it's not just about home buying that sentiment is low. Home sentiment is low across the board, really, when it comes to the economy. And it makes sense, if you look at it, because the reality is home buyers are getting hit with volatile rate environment right now. Labor market, there's a lot of headlines out there right now in the labor market. You've probably seen them yourself, Dean, all this news about, these huge tech companies, especially laying off, tens of thousands of workers. Not a fun thing for, a consumer to open their news app and read about. The good news is that I think overall in the labor market right now, what we see is that it's pretty much a low hire, low fire environment. While there isn't a lot of hiring going on, the actual level of fires isn't really that high. Employers are holding on to their labor. They're just not really expanding their labor force. That being said, that doesn't get the news as much as, 10,000 workers getting laid off in tech giant gets the news. So they're getting hit by that. They have the poor affordability issues that we've seen. And Kara was just talking about, even though they've, improved a bit here, affordability is still very difficult for today's consumers. And you also have two other big things. Prices have come down or are coming down or might come down, depending on how what market you're in, really. And that gives consumers that lack of confidence that, is this the right time? Do I need to wait for a little bit longer, capture, better prices? And then, of course, you have the big elephant in the room. There's a war in Iran going on right now. Headlines are every day about that. Is it stopping? Is it starting? What's it going to do to the economy? Who knows? That's really what the consumer sees every day. And if it were just one of those things, I don't think this consumer confidence issue would be as big as it is, because each of these things in isolation, while difficult for the consumer, is not just a reason that all these consumers are going to stop buying homes. If you really talk to consumers out there and talk to builders, there's a lot of sentiment like the war in Iran has paused consumers. I don't think that's totally true, because if you were to just ask a consumer, are you pausing your home purchase because there's a war? They probably would say no. Yeah. But are they pausing it because this is just another thing that's been layered on top of all these other things and giving them something to worry about? Absolutely. All of these things at the margins have just really added up to create a consumer that just has to say, man, is it the right time to make the largest purchase of my life right now?
Yeah. Well, I mean, you mentioned the layoffs. A lot of the tech layoffs have kind of settled down now. They aren't as bad as they were. But is it still that underlying anxiety? What's AI going to do to me next? Is that what we're dealing with? That you said it's cumulative effect of, even if my company hasn't laid anybody off recently, I don't know if they're going to tomorrow.
I totally think that is out there right now. And what we hear from a lot of builders and just folks out there in the market is that, the AI fear is there. And I think right now, what I would say is that one of the bigger risks on the AI side of things is what it's going to do with the stock market. It's just in the news today, stuff with OpenAI, what it's going to do to NVIDIA and all these different, tech giants that have really led the stock market's huge rally over the last couple of years based on all the AI spending. Right now, though, a lot of the buyers who are out there are really looking at the stock market. And the stock market is not the economy, but if the stock market goes and tanks down, that's a lot of consumers who are potentially threatened by it. They have, maybe stock options in their compensation, or their, 55 plus buyer whose 401k and retirement really depends on stocks remaining high. And so the risks there with AI and with a lot of the economy right now, because a lot of the economy, you hear about the K-shaped economy too right now, that top 20% or so of spenders is really driving a lot of the spending that continues in the economy. So we're really just kind of balanced on a smaller set of the market. We're balanced on AI company earnings in the stock market. We're balanced on top 20% of earners. So it just leads to there being more fragility out there right
And
now.
another issue you mentioned, Dylan, a second ago is immigration. And I think, Carrie, you did too, is that doesn't immigration affect a lot more markets than a lot of folks think? Everybody knows it's going to affect your tech-centric markets like the Bay Area or Austin. But isn't it also a little bit of a hurdle now too, because immigration has slowed so dramatically in a lot of markets throughout the Sun Belt?
It's definitely been a headwind. And especially you think about your markets that are heavily concentrated with your H-1B visas. And a lot of those are going to be your tech markets. But here in Atlanta, Raleigh, Austin, I mean, it goes across not just your tech heavy markets out in the Northwest, it's across the Sun Belt too, where you do have consumers that have been affected by H-1B visa application changes, renewal changes. And even if they haven't been directly affected by immigration policy changes, that kind of fear of what happens if someone, one of my family members is affected, or just in general, I don't want to make, again, a 30-year purchase and then not be able to leave the country and come back. And so immigration domestically has slowed, immigration internationally has slowed to lowest levels we've seen in quite some time. And that's definitely a damper on housing demand.
And it has product impacts too, doesn't it? Because like multi-generational housing has been so hot for so long, but a lot of that has been immigrant demand. If that kind of dissipates, do you change what kind of product you do, perhaps? Dylan, getting back to kind of the war, tariffs, all that stuff, how has that been impacting things like hard costs and supply chains and those kind of factors here early in the year?
Yeah. So one of the things I didn't mention too much with the consumers is really gas prices. That is the most, visceral, visible effect that today's consumer sees when we're talking about effects from the war. Dean, you and I live in California. I don't know what kind of car you drive, but I drive a hybrid.
So
even though it's a hybrid, I still I'm paying right now about as much as I used to pay with my full gas car. So sure. I'm very glad I made the change personally, is all I'll say. But gas prices are up. And it's not just like pure gasoline prices that matter when we're talking about costs, because we're also talking about diesel. And diesel prices, I think they're down very slightly from their peak over the last couple of weeks, but they're still pretty high across the board, and have reached like almost historic highs in some areas. And those diesel prices are a major inflow into construction costs for the construction industry. And so we actually asked builders in early April here, and we were kind of discussing, we were worried we were asking it too quickly. Really, hey, builders, are you guys seeing, surcharges? Are you seeing delays related to gas prices? And like 40% of them were saying, yeah, we're seeing that already. We are already hearing from our suppliers that we're having delays on deliveries or surcharges on our deliveries because of fuel prices.
So it's almost immediate.
Yeah, pretty much. That's not to say that they've seen, huge cost pressure yet. A lot of builders are still able to push back because starts have come down so much across the board, both for the single family and multifamily side of things. But it's a huge pressure on builders right now because they've really seen like actually decent cost relief, which is not something you see very often in the new construction market. Cost relief isn't an easy thing to come by. But across the board, builders are seeing cost relief, especially on the labor side of things.
Okay.
Because,
so it's a lot of pushback because those folks aren't as in demand as they were
no,
that long ago.
Really not. And so builders have had negotiating power, but they've also had negotiating power with their material suppliers. That's just really what we're seeing now is that costs are basically flat. The level at which builders are seeing cost relief has really slowed down. And so what gives some concern there is, are we going to see costs reaccelerate, especially if gas prices remain higher for longer? Because even if the war ends tomorrow and the strait reopens tomorrow, gas prices and fuel prices, they don't just go down overnight. It's going to take.
They always go up much faster, much faster than they go down.
Yes, they
Logic
do.
Isn't quite there on the side of the oil industry, but there's not much we can do.
No, and we're getting into summer too, so that leads to higher gas and diesel prices as well. So it's a tough headwind for the builders because they've seen so much trouble on the demand side with the buyers and the incentives on their margins. Costs have been actually one of the few bright spots there on margins that's helped them, remain profitable and offer these incentives. But if we see reacceleration on costs, it's just going to hit them in a place that's already been hurting, and that's on their margins.
How about land? Have you seen any give on land prices?
A little bit, not enough to make builders happy about it, but a little bit. The land market is really one of the last things to shift when the market shifts. And there's a lot of reasons behind it. At its core, though, most land sellers are really, long-term owners.
Mhm.
They've owned this land. I mean, for some of these folks, they've owned the land in their family for generations, 200 years sort of thing. So they don't really have, unless there's, some really compelling reason, they don't really have any reason to sell today when the value of the land might not be exactly what they want. In a lot of cases, they are more than happy to sit there and wait for prices to come back. We have, however, seen some relief in prices in a couple of situations. So first, last year, there were a lot of retrades out there, builders getting rid of some land on their books that often they hadn't started on construction yet and was underwritten at much lower incentive levels. So the margins just didn't really work out anymore. So builders were putting that land on the market. And so there were some deals that came out of that for sure, that some people found some price relief. There is also a market right now for some finished lots that might see some price relief just because builders are hesitant to take on short-term land right now. So, if there's a developer out there that needs to sell these finished lots right now, there might be some relief there. But really where there actually could be some land value relief for the builders is in really those farther out areas. Builders right now are prioritizing, they want the high quality locations. They want the places that they know are going to sell, that they know they can get solid margins on. And while the land seller definitely isn't getting as much of a premium as they once were on, those locations as they were over the last couple of years, those areas do still have some demand and do still have some price appreciation.
Because affordability is such a critical part of the equation too. I mean, I know that I've heard the same thing too. It's you want to kind of flee to safety, and safety is usually those closer in locations. But
there's a flight to quality right now.
There is, but at the same time, with affordability so critical, those somewhat out locations make a lot of sense because you can get product to market.
They do, as long as you can make the risk make sense. And that's the issue right now. Builders want quality land right now is what we see. If you go out into those C and D is what we call them, the ex-urban rural locations, we actually, from talking to land brokers in our residential land survey that we do, brokers are saying, hey, there's some price relief here. It's not substantial. We're not talking, prices come down 50% or anything. It's, single digits. But seeing land prices go down even slightly is definitely a notable shift. And it tells you really where the market is right now. Builders are looking for quality land. There are definitely cases where getting stuff in the farther out locations can make sense, especially if they can get a deal on it. But overall, pricing is sticky. There are cases where builders are seeing relief, but it's not offsetting, I'd say, the construction cost risks if those start to reaccelerate right now.
So let's look forward a little bit. Kara, by the way, listeners, we're recording this at the very end of April. So those are the conditions with which we work. Hopefully, by the time you listen to this, the Iran war is over and things are looking better. We'll see. Given that time constraint or given that timing, what do you see happening next year in May and June?
Yeah, I mean, for all of the reasons we've talked about today, Dylan listed that in isolation, all of the headwinds that are present right now today in the spring 2026 season, maybe singular. They're not what makes or breaks the year, but added on, they've really created a kind of backdrop for pretty muted rest of 2026, similar to what we saw in 2025. And, we ask our builders, we survey on traffic ratings, the quality, the volume, and kind of their expectations. And they're at the worst levels we've seen in March, really in survey history for a lot of the metrics. And that's not a great sign. I came from a builder. I know that builders are inherently the most optimistic people in the industry.
Next to developers.
But so when you have some of the weakest March ratings in terms of your expected sales over the next 6 months coming out of builders, it's clear that these headwinds are persistent and are going to continue. And we don't have one saving grace for the spring season and for the rest of the year. So you see it in our forecast. You see it when you talk to people and talk to builders, people in the industry that are working on their forecasts for the rest of the year as well, that it's looking like a pretty muted rest of the year. We still have the uncertainty. Even if by the time this podcast airs, the war is over, we still have a lot of hesitancy and uncertainty that is just weighing down that consumer. We still have inventory in pockets of markets that are still operating at really high levels of new and resale inventory. It's continuing to put pricing pressure on the builders. And it's pretty clear that this spring season is not the typical pricing leverage backdrop that a builder would have, raising lot premiums, making those base price increases. That's just not happening right now. So I think it's a lot of more of the same to come for this year. I do think we'll see, builders have been really strategic and they've responded really quickly to all of the different headwinds that have presented over the last couple of years. So we've seen their starts slow meaningfully, right? In response to the elevated inventory, in response to the slowing starts. I think we can expect to see builders start to try to take a shift towards getting back to a more comfortable ratio in terms of their pre-sales, dirt sales versus their specs. Spec inventory has been a really useful tool coming out of COVID. Supply chain issues created a lot of efficiencies, historically low inventory, put those move-in ready homes on the ground. But as we have the elevated inventories, we have pricing leverage pretty much non-existent. I think we're going to see builders try to get back more towards leveraging those dirt sales to preserve some of their margin, which I think will be a shift that we've seen. It's not going to be an overnight shift. It's definitely going to be a slow roll, but I think there's a lot of preference out there to try to preserve margin in that way.
That's difficult though, because right now you really do need a QMI to make sales against your competition. If you're in a kind of a food court submarket environment, that's really difficult to sell dirt right now. You're mostly selling spec.
It's very difficult. And, you can hear that when you listen to the builders' earnings calls as well, right? They have the desire to preserve margin with their pre-sales, but the majority of their sales are still coming from those inventory homes because that's what is available and that's what buyers are comparing against the community down the road.
I will say this about inventory, though, because you mentioned that a lot of markets do have very high inventory right now. But in those places, you're still seeing markets be okay where there's low inventory. I work in a lot of very high priced, mostly in California now, and inventory is not an issue there. We're still seeing pretty low months of sales, inventory on the market, resale and new. But it's, as you mentioned, is still a challenge. Are you seeing any bright lights in niches like the luxury niche? Dylan, I think as you mentioned the K-shaped economy earlier, I worked in a lot of high priced markets. We are definitely seeing, very surprising where those top deciles are the strongest parts of the market. Are you seeing that in other parts of the country?
Yes, that comes up a lot in our conversations. We're on calls with builders, developers, private equity from across the country, and it's pretty consistent that the K-shaped economy is very clearly at work right now. And we continue to see that luxury, more custom segment at those higher price points be a little bit more resilient. And it's that entry level that's still the pain point, right? So not only are they dealing with the uncertainty issue, but those buyers have a monthly payment that they can't go above. And so we've continued to see luxury outperform. When you get in terms of that first move up buyer segment, it's a little bit more mixed depending on what metro you're in. And a lot of that depends heavily on the local environment, how competitive those new home markets are, how heavy the inventory is on the resale side. But overall, from a national standpoint, we continue to see luxury outperform the other segments.
Both of you, is there anything you think new home folks could do, either more of or new that they're not doing, to maybe entice some more folks into the offices or online?
I would say right now, and builders have I think builders have learned this quite a lot over the last couple of years, but I think it's more important than ever right now is just buyer education.
Yeah.
The buyer is hesitant right now. And even if it's not, the top of the line issue, maybe it's affordability or qualification or what have you, every consumer's story is different, but the education portion right now is just absolutely critical. And that means it's going to require a little extra hand holding to walk the consumer through the process. It might require some extra incentives, which it typically has been the market over the last couple of years. But the reality is, people are still buying homes and people will always need to buy homes. But what the builder has found is they're going to need to continue to do is that they have to work with the consumer very closely. There's no order taking going on anymore. It's a process right now to help that consumer feel comfortable with their home purchase.
Yeah. On that same note, we saw the new home segment be so much more resilient than the resale segment because of these builders, specifically the big ones' ability for those expensive rate buy downs as forward commitments. And I think, Dylan mentioned buy downs are still, a lion's share of what incentives are being laid out today, but it's a very custom process, right? So a lot of cases, the buy down does make the most sense in terms of getting that monthly payment down, but they're not order taking. Those sales consultants are sitting down with those prospects and saying, okay, what combination of incentives will get you over the line? Is it a little bit of closing cost coverage, a little bit of design spend, a lower lot premium, your buy down plus maybe some down payment assistance, whatever combination it is what's allowing these builders to outperform the resale market. And I think, right to Dylan's point, educating the consumer on what actually is available. And while your inventory home may not be a custom design selected home, your incentives can be selected and customized to what fits your financial situation the best. And I think builders definitely need to leverage that ability over the resale market and educate their consumers that we're going to work with you and we're going to create whatever plate of incentives works best for you specifically.
Okay. Let me ask you last question for both of you at the risk of sounding incredibly naive. But Kara, you mentioned a little bit while ago that, when mortgage rates pop down just a little bit, they're in the low sixes, still pretty high, still necessary for a lot of new home builders to incentivize and buy those rates down. But the market was doing pretty good in January and February. Is there an argument for that if we do see the war go away and if mortgage rates do ease back a little bit into the low sixes or so, is there an argument for a little bit of a repop here in the not too distant future?
I definitely think there's an argument for some momentum shift right now, right? The momentum does not feel like it's going in the right direction right now. If all of those things were to happen, I do think that can shift momentum. Again, is it going to, turn on this full faucet of demand? Maybe not, but like Dylan mentioned, people will always have to buy homes. There's always going to be the need to upsize births, deaths, divorce, job relocations, right? There's a floor to home sales. So it's going to be able to capture those people who have been waiting to upsize. Me saying that in my 3-bedroom house with a 2-year-old now, I need to upsize. But there's always going to be people that need to move. And so you do have some stability on the macro front. You do have rates come down again to those low sixes, maybe start seeing a 5 again. I do think it is going to renew some momentum into the rest of the year.
2-year-olds, though, my memory from 2-year-olds is that they need their own place, a separate apartment. Maybe like an ADU above the garage is what a 2-year-old should live in.
An ADU would be great now.
Yes, a soundproof ADU separate from the house is my memory. I just really appreciate that both of you accepted my use of the phrase repop as a legitimate American word. So thank you for that. I appreciate that.
Add it to the dictionary.
Dylan, any thoughts on, do you kind of concur? Do you think there's I don't want to get overly optimistic here, but if things settle down?
Well, I think we can definitely have some opportunity for 2027 is what I'll say. Look, I think the reality is there's a reason we're talking here in spring.
Yeah.
Spring matters beyond just maybe rates are lower in spring. Spring matters, and spring is when people buy homes for a very good reason. That's not to say that we can't see, as Kara just said, better momentum in the rest of the year. There's no reason to think that if things really calm down, rates come down an appreciable amount, and really remain stable is another big part of that too.
Yeah.
That we can't see, maybe a seasonally better than expected fall and winter. Now, is it going to be a real pop? I don't think that's going to happen. And unfortunately, because all of these things have really compounded on the consumer for so long, it's going to take time for it to filter.
Agreed. But the counter to that is that most of these things have been self-inflicted wounds, in all honesty, and those things can be corrected.
That's true. I think it does take some time, though, and I think it will take some time for the consumer. But as I said, there's no reason to think 2027 we can't bring it back.
I love the way Dylan, and what's ultimately a fairly pessimistic view for the rest of 26, makes it sound like it's optimistic. That's well framed, Dylan.
That's what it's all about.
All right. Well, I appreciate you guys. Thank you guys for coming along and helping us figure out what's happening in the spring. Maybe it wasn't great news, but it's like you said, things are fairly stable. Homes are still selling. There's still transactions. The market isn't dead despite all these headwinds. That's not bad. Thanks, guys. Appreciate you coming on.
Appreciate it, Dean.
Thanks,
See you next
Dean.
year.
This has been Dean Worley for the New Home Insights podcast. We'll see you folks again in a couple of weeks. Since you forgot to hit the stop button, I'm going to take a second to tell you about our weekly Building Market Intelligence newsletter. Over 40,000 smart folks get these timely takes on the housing market in their inbox every week, and you can too by heading to jbreg.com/subscribe and signing up.